let's take at this. Let's say you build a portfolio right now, investment grade, you get to something like 7% yield. And the yield is a good forward predictor of future returns. So keep in mind the 7%. Now I want to increase the yield. There are 3 ways to doing it. Leverage, going down in credit quality, and becoming more liquid. There's no miracle. That's the way you get to higher return. And it may or may not be attractive depending on relative value. So John needs to borrow money for his private equity business. I don't do private equity, but he's a fiduciary, right? So he's going to try to borrow money. He's going to call his 10 closest friends, I'm one of them, and he's going to try to get the best deal for his leverage buyout. And there's a classic problem of Unis curves. And so if I can get 7.5 in direct lending in a weak single B credit, he's doing his job. I may not doing mine because I don't think it's that attractive. Right. But if I can get 10, then I think it's very attractive. And so it's all in the price, and I think you have an equilibrium where everyone is trying to do the right thing, but market prices dictate behavior, and one shouldn't take illiquidity for the sake of taking illiquidity.
So I think that's the point that it's really about return, but for John's case, it's really about the assets by the smaller investors. So maybe before long, we're going to see tokenization of private equity in some case. Anyway, but it seems that these are 2 very different markets. So in terms of investment strategy, your philosophy, your risk management, and also, do you also see the kind of synergy or complementarity of getting into 2 different markets?
Well, I definitely think there's a complementary nature of bringing liquid assets next to private assets. If you think about the liquid market is so important for investors, but the S&P 500 today is 10 stocks or 40% of the overall market cap. And we know there's obviously a lot of volatility, sentiment moves things. We saw that certainly during COVID or after Liberation Day. Liquid markets move very, very quickly. So the idea of having some ballast for investors, institutional, insurance companies, individuals, makes a lot of sense. You know, what it gives you is exposure to real estate at much greater scale than you can get in public markets, things like infrastructure. Something like almost 90% of the private companies in the US that have more than $100 million in revenue are private. And so to be able to construct a portfolio that gives you access to all of those companies and puts it side by side with your liquids portfolio makes sense. So no one's up here saying you're going to put 100% of your assets in private markets. But should you put 10, 20, 30%, most of the big institutional clients we have put about 1/3 in, because again, the premium returns and the diversification benefits. So to us, this is just sort of a natural journey. It continues to expand, but again, you have to deliver for the clients because they are trading away a measure of liquidity.
So let me take a slightly different angle. In fixed income, you have a biodiversity second to none. So you have a very liquid market, you have structured product, you have asset-backed finance, you have a municipal bond market, you have more exotic type of payout like royalty finance and aviation and so on and so forth. And so at any point in time, different segment of the market may be more or less attractive depending on what the opportunity is. So I think either Ted or David mentioned before that investment grades are very, very tight. They're tight. It's good for John to borrow. It's less good for me to invest. And high yields are very expensive. You know, we have this chart which shows that between 1992 and 2008, you made 70 bips a year owning high yield. You lost everything in 2008 and more. And so we haven't seen a recession. And so to some extent, some of these returns in higher octane type of fixed income haven't been really tested. And I'm not being provocative. I'm making a very obvious point that in a growing economy, when things are good and there's no recession, things look better than they ought to on a risk-adjusted basis.
Yeah, that makes a lot of sense, I mean, in terms of allocation. So let's move on to the next question, which is about private markets. Now, John, the first question is, some say that the private credit space has been having a lot of strong traction in recent years. And that partly has to do with the challenges in fundraising as well as exit in the PE space. What's your take on that?
I see it a little differently, Daryl. I think it really has happened because of the excess return you've been able to deliver. If you think about what private credit is, we're bringing an investor, let's say an institution, right up to the borrower, and in the process, eliminating a lot of origination, securitization, all those costs that ultimately take away from the individual, from the ultimate end investor. And so when you're able to have that direct-to-customer model, farm to table, you can deliver higher returns. For our insurance clients with private investment grade, we've been delivering in the last year 170 basis points premium. So if you can deliver 7% instead of 5%, that's very helpful. Similar story in the leveraged loan market versus direct lending, where again, by having that direct-to-customer model, you provide a premium. So that, to me, has really been the driving force. It was certainly accelerated after the inflation surge, after rates went up and spreads widened because you got these very, very high rates of return. But that cyclical element, as it goes away, doesn't take away from the long-term secular benefits of private credit. And so I think this trend will continue, and it will take up a larger component of investors' portfolios. Again, they'll still have a very large liquid fixed income portfolio, but just like they have a big public equity portfolio, they now have a larger private equity portfolio. It'll be the same dynamic in credit.
Okay, thank you. That's the upside, but let me talk a bit about risk in the private credit space. Now, in a media interview in August, you said, and I quote, "Private markets haven't been tested." And recently, we're seeing some high-profile bankruptcy cases in some private credit-backed investments. There's even mention of the crawling little creatures out there.
Not my words.
So, what's
no, look, I think here's the way to understand it. You have a mortgage market which is super efficient. For lower quality borrower, you always had other form of financing where the credit is much worse and then the risk of fraud is higher. I mean, I was telling you when we were preparing for this that I remember a case in 1999 which pretty much looked like the one we're seeing today. Right. And so if you've been through this and you've seen fake invoicing and all of these things that we both know about, I think you sort of mentally prepare for it and you make sure that you don't do it. And so that's, I think, part number one. How many more are there? I think it's very hard to tell. I think everyone in this room scrub their book and try to make sure that none of us are exposed to this. But it could be that one of the sector where you've seen a lot of activity, like software, for example, where AI is going to be a major disruptor, you're going to have a problem, not because anyone is doing anything wrong, simply because there's a business model that is being destroyed by technology. And I think that's, that's a Schumpeterian way of looking at an ecosystem. And I think that's, I think that keeps everyone in this room awake at night because, it's a good, bad thing in terms of what's happening.
John, you want to jump in on that point?
Well, I would agree with Manny's comment. I think these high-profile bankruptcies were interesting in that they were non-institutional borrowers. What we tend to do is lend to private equity firms or public companies. These were non-traditional borrowers. They also, it appears, committed fraud, asset-backed, where there wasn't really assets there. And then to look at that and say somehow, therefore, the direct lending market or the investment-grade private credit market is flawed, particularly where in both of the high-profile cases, these were bank-led situations, that seems like an odd conclusion. But it matters how people underwrite. And yes, you have to be mindful of what you're doing in the credit space. But I think these are both idiosyncratic. And when we look at the overall credit books of the banks, of public debt markets, of the private credit, you see very low default rates, very low losses. To me, that's more representative than a couple of these idiosyncratic cases.
Okay, thank you. So perhaps no need to grab the pesticides, at least for now.
Agree.
Oh, okay. So my next question is on AI. So everyone is talking about AI. We can't avoid that. Private credit and PE, big investors in AI infrastructure, data centers in particular. But there's also increasing concern whether there's actually a bubble out there. And so there's a guy saying that, well, okay, so this time it's probably a good bubble. Well, meaning that, well, the investment put into it, the productivity gain that will actually benefit, even lasting benefit for the society, even if the shares collapsed. So do we have a bubble, good bubble or bad bubble? John?
I'm a little more optimistic. Whenever you have this kind of change, doesn't matter, railroads, electricity, the internet, there will be misallocations of capital, there will be bad business models, there will be people who lose, no question. And there'll be an excess of enthusiasm in certain areas. But the power of this technology is really remarkable. The idea of super intelligence at scale at almost no cost other than electricity, that is really powerful. And when you start to think about the use cases in coding and customer service and content creation, the list goes on. And we're at the very beginning of these use cases. If you think aggregately, there's $60 trillion of labor spend. If this technology makes individuals, companies 15% more productive, that's $9 trillion a year. That can cover a lot of spend for data centers and for gas plants and all the infrastructure that needs to make this compute power a reality. So I'm definitely aggregately more optimistic that what's happening makes sense because the size of the prize is so large, but acknowledging there'll be losses. The other thing, and I think Manny was very smart to point this out, is that everyone's focused on this bubble over here. I think what you have to be concerned about as an investor is a disruption that's coming. It could be lower value added IT services. It could be certain horizontal enterprise software companies. It could be what happens in the auto supply chain or auto insurance as a result of autonomous vehicles. I think underestimating what will happen, even if these changes take time and as multiples compress, as people get worried, that's the thing as investors we've got to worry about. There seems to be these days much more focus on the bubble and misallocation of capital. I think we also want to look behind us at the pace of disruption and what it could mean for our portfolios.
But you also mentioned that Blackstone is actually placing AI on the top of your risk list. What do you mean by that?
Well, we're just looking at every deal that comes through the door, and we're saying in the first 2 pages of the memo, tell us about the risk of disruption. We're also looking at our existing portfolio and sort of saying yellow, red, green, you know, how much risk do we have? Is there a way to exit this company faster or this credit faster? And then I would say in order to reduce our risk, we're also really focused on the picks and shovels. So really focused on being the biggest investor in the data center space with long-term leases, really focused on the electricity that's needed for the data centers, for the robotics, for the autonomous vehicles. So I think as investors, you want to try to find ways to play this derivatively and reduce your risk because there will be some losses.
Thank you. Manny, you just did a quick deal. So can you tell us a bit more about that? And then your thesis of investing in AI and apart from data
Well, I think the beauty of it, you know, in terms of, I mean, and you know, I'm a little biased because we just did a deal with our friend from Morgan Stanley, a $29 billion giant, lending to one of these companies. So, you know, I may have to eat my own cooking. But the company who issued these giant bonds all have AA or AAA rating. I mean, it's incredibly safe. And because the market valuation is so high, if you plug the amount of debt being borrowed in a Merton model in terms of debt to equity, you find that it's pretty riskless and very attractive. And, you know, whether they decide to go to the public market like Oracle or whether they decide to go private, we don't know. And, you know, once again, they have very good and very smart CFO who are going to optimize their borrowing ability, and that may be or may not be good for, you know, both of us, and that's totally fine. The one word of caution is that we don't know what inference is going to be in terms of AI, and there's a lot of possible outcome, and I think none of us really know. And I think I would sort of caution with what may or may not happen, because the degree of certainty you have 5 years from now it's just very hard to know where we're going to be. So maybe we're not building enough data center, maybe we're building a bit too much. Who knows? And maybe the data center, some of it will be obsolete, or maybe they won't be. And I think there's a degree of uncertainty in every single big innovation cycle, and that's one of them. And I think we'll recognize this, and we'll try to ride the wave as well as we can. But sometimes you ride the wave and you fall in the wave, and so that's the.
Before it's too late.
That's right.
But I think that word of caution is very helpful. We don't have much time left, so maybe just one last question, moving closer to home. So we just discussed just now while we're waiting. So the public markets here in Hong Kong and in the mainland has been doing, well, the sentiment has come back quite well. So John, how about the private market?
Well, the private market lags a bit on this because as a private investor, your time horizon's longer. So when there's geopolitical uncertainty, when there's a lack of liquidity in markets, private market participants, tend to fall back a bit. What's encouraging is the outcome of the discussions last week, where the economic tensions are starting to come down. We've definitely been believers of letting the tariff diplomacy play out, that it ultimately would settle, that it's in both parties' interests to get to a better place. The second thing is just the revival of the public markets, the fact that the Shanghai index is up big, the Hong Kong index, the IPO market here is now going to be the leading IPO market in the world this year. That signals to investors liquidity is coming back. So I think you'll begin to see more focus on private markets in Greater China. I think there'll be a lot of focus on the domestic market, on growth and consumption, on leisure, hotels, logistics. Those things make sense to me. And I think Hong Kong will probably be the tip of the spear here in terms of the recovery. You can feel people coming into this market. The sentiment is changing. And so this place has had a tough few years, but it feels there'll be some compelling opportunities, particularly in the real estate, which I know has been badly beaten up.
Well, of course, you are a big real estate guy, so, well, that's a good news. Many, on the credit bond side.
Very, very simple. I think every single investor we have is under-invested in Asia for very obvious reason. If you look at benchmark, Asia is a much bigger part of the benchmark than what they invested in, and so there's a flow of money. Some of it goes through global bonds, some of it goes through global equity, some of it goes to local equity. Hong Kong is the gateway to China and to Asia. It's the center. It's where every one of us has big offices, and it's the role you play, and I think it's very good in terms of capital markets, but it's going to grow. And remember that one of the flip side of what we've seen in the US is there are some countries like Canada and Australia who have more difficult relationship with the US, where their own capital market is not big enough to be able to allocate locally. And so all of a sudden, there is some rebalancing from the US to other part of the world, and you've seen the dollar correct by 10%. I don't think it's over, but I think you've seen some smallish realignment in terms of flow of funds, and I think you'll see some of this happening here in a positive way.
That's actually very good advice for us while we and the SFC are rolling out our roadmap to really grow our bond market here. Thank you so much for the advice. Now, we're out of time. Again, thank you so much, gentlemen, for your good advice. I just hope that you'll continue to capture the best of both worlds. Ladies and gentlemen, big round of applause. Thank you.
Thank you, Daryl, and our speakers. Please remain on stage for a group photo. Please look towards the back for our media friends. Thank you again to our panelists. You may now return to your seats. Thank you. The private equity landscape is navigating a period of change, with shifting investment strategies and an evolving market environment that are reshaping the competitive landscape. Let's hear from the industry leaders on their take of the state of the private equity. Please give a warm welcome to our moderator, Juan Delgado Moreira from Hamilton Lane, and our panelists, Joe Bay from KKR, Rob Lucas from CVC, and Harvey Schwartz from Carlyle. Juan, over to you. Thank you.
Thank you. Good morning, everyone. I think the job is, I'm standing in for an extension of HKMA. My job is to ask tough questions as an investor would look at this, and notice the challenge word on the title, right? Fortunately, thanks to the previous panel, we don't have to cover private credit. So that one's done. But I think it's fair to acknowledge that we have a period of transformation and change in the industry. All of us are meeting clients all the time. The first thing that comes top of mind is for the last 25 years, out of those 22 years, you outperform public equities. Congratulations. Unfortunately, the last 2 or 3, you have not. And so it's easy to get used to 22 years of one trend. What does that mean for the future? But I also want to connect that to a number of new developments in the industry, such as the development of secondaries, continuation vehicles, the explosion of a number of new transactions that are taking more and more space into portfolios and becoming front of mind. So with that as a backdrop, I'd like to go to Harvey first, since he's far out in the corner, and just can I have your perspective to kick us off on this evolution and this journey and your outlook for 2026?
Sure. Well, it's great to be back in Hong Kong. Congratulations to Eddie and the HKMA. What a fantastic event for all of us. A little bit of this has been talked about during the course of the morning. I think it was Ted that talked about the fact that companies are staying private for longer, up to 14 years. If you actually go back to you take a look at the Wilshire 5000, the Wilshire 5000 peaked in the late 90s at 7,500 companies. Today, it's just over 3,000 companies. And there's this massive transformation of public companies, not just delaying becoming, private companies, not just delaying becoming public, but also not becoming public at all. And what's occurred during that period, one, as we all know, is the transformative nature of private capital. It was the complete build out from the early days of private equity to private credit, venture capital, and the full suite of capital tools that allowed CFOs, treasurers, CEOs to actually stay private. And it was the most efficient form of capital, in addition to all the public capital they could get, whether they're dealing in the bond market, et cetera. But it really was just about efficient capital allocation. Along the way, there was a proliferation of private equity firms, and there were extraordinary returns. And if you look at the cycle, all that's really happened over the last couple of years is there was a period of congestion where capital was being recycled very, very quickly. But it's gotten a lot of attention. I actually think at this stage, the narrative is a little stale. If you see what's happening in the industry, the private equity ecosystem, if you think about private equity primary and secondary activity, one of our fastest growing businesses, as you know, is really just in the beginning of creating a more dynamic flow of capital for the entire industry. And I think when you step back, the questions we have to ask ourselves, against the backdrop of a lot of things that have been discussed today, when you think about what's happening geopolitically around the world and some of the big macro trends that we're just living through a huge shift in, going from a deflationary world to a slightly more inflationary world, global cooperation, steep inflection in technology again, the demand for capital of all forms for the next 5, 10, 15 years in the business that we're in is only growing. And everywhere we go in the world, and it was discussed here earlier today, it's about economic growth and economic competitiveness, and the demand for capital will be very high. So I feel quite optimistic. You know, we've taken 4 companies public in the last year, largest privately owned company in Japan, largest private owned company in India, third largest private company, third largest IPO in the United States. The capital is really starting to return to the industry, but more importantly, the opportunity set going forward, because the capital demand is high and we're not seeing a structural change in how companies get capital and how they optimize capital.
That's great. Harvey, you mentioned liquidity there indirectly and speed of recycling capital. Can I go to Joe now, actually? In how do you answer that question from investors? What's your guidance to liquidity? Another statistic that is quoted, Hamilton Lane data on a run rate basis, this industry on the PE side was delivering 23% of your prior NAV in liquidity on an annual basis. That wasn't the case last 2 years. I'm sure you get this question. What's your guidance? What's KKR's guidance for that?
Well, I think context matters here. So it's hard to generalize about the entire industry because I think the bifurcation of performance is quite extreme today and probably more bifurcated than it's been in the last 10 years. I'll give you a good example. I think what's happening now is some of the congestion on the exit side. You really have to contextualize really around what happened in 2020 and 2021 and early 2022. The industry underinvested in 2020 in the middle of COVID. Capital markets were shut, a lot of dislocation, and the industry didn't lean in enough to deploy capital in that window. In 2021, with the response by governments around the world, the massive liquidity that was injected, interest rates going to unreasonably low levels at that point in time, there was a rush of deal making at high prices when there's a lot of liquidity in the marketplace. And if you think about our private equity business, you know, we're holding companies for 4, 5, 6, 7 years, right? Those deals that were done in 2021 at the peak, if you will, at high valuations with a very aggressive amount of leverage because interest rates are so low, those are the deals that are stuck today in the industry. But again, I think what you're going to see, like the firms that are doing well in this environment are the firms that were very disciplined, I think, in terms of pacing of investment in that time frame 4 or 5 years ago. You know, our deployment in 2020 went up 40% in the middle of the dislocation versus 2019. And our deployment was flat in 2021. Right, so if you look at our US private equity business in the last 5 years, for every dollar we've invested, we've returned $2 of capital to our investors. This year is going to be our big year for Asia liquidity, given the stock markets in this part of the world. Half of our global distributions in private equity are going to come out of Asia, which really speaks to the capital market development in this part of the world you're seeing. So I think a lot of what you're seeing, the context really explains a lot. You know, one of my partners recently did an interview, and she said, how is it that there are more private equity funds in North America than there are McDonald's franchises? Right, and it's true. 14,000 McDonald's locations in the US, and more than that in terms of private equity funds in the US. So it's hard to generalize. I think you have to really look under the cover and see how people have invested. And I think today people also talk about the slowdown in deal making and activity. I think people are resetting and trying to get back to basics. You know, valuations are objectively high today, right? People should be more cautious in deploying capital in this type of valuation environment. And there's no shortage of financing, whether it's public financing or private credit financing, right? And I think you have to be very disciplined in a market like this and focus on what private equity is meant to do, which is fundamental operational value creation in companies, bring better governance to the table, and I think that's how you're going to generate consistently and outperform the public markets.
Thank you. Rob, to you, Joe connects cycle, deployment pace, vintage. From a European vantage point, do you see any difference in terms of the point in the cycle, the level of exits, and the outlook?
Yeah, thank you. And thank you, Eddie, for having us back. It's great to be here. I think it's a very exciting time at the moment, I've got to say. I think it's very hard, as Joe's just been mentioning there, to underestimate what we've been through over the last 5 or 6 years as a global economy. It's very easy to forget that come sort of February, March of this year, it'll be 6 years since COVID hit us. All the destabilization, all the volatility since, geopolitical, economic, and actually the resilience of the global economy, but the resilience of the world in which we're in, the alternatives, I think has been pretty astounding in actual fact. I totally agree with Joe that we're seeing a real bifurcation in the industry. I mean, it's always been there, but of course, the more players you have, the greater the levels of volatility within the market, the more that shows through. So, just taking your point about the European outlook, yeah, we are seeing strong flows into Europe, and Europe's always been a very interesting and successful place for private equity investing and alternate investing. I mean, just by way of returns over the last decade, I think it might take quite a lot of people by surprise that the net IRRs in Europe over the last decade have been higher than they have in the US. 16% net IRR over the last decade in Europe versus 15 in the US. But it's even more interesting, and the key to investing in Europe, when you look beneath those figures, when you look at the amount of alpha, and alpha's been talked about a lot this morning, and I'm sure will be further. It's very, very important within our world. And if we look at what Europe has managed to produce, within Europe, half of that 16% is alpha. In the US, there have been, we know, very strong tailwinds to the US market. But that has actually meant that the levels of alpha have been 1.5% as opposed to 8%. Now, why is that? Well, the US market is a very active, very liquid market, but it's also a very efficient market. Europe is a fascinating place to invest because of all the challenges and the imperfections that the European market has. And that means that if you have players like KKR, like Carlyle, like ourselves on the ground in those local markets, the ability to produce high alpha, the ability to produce strong returns in that market is very strong. And that is what's really recognized by the most sophisticated LPs and institutional investors out there.
Just to, before I let you go on liquidity, all of you, secondaries was mentioned as well. It's front of mind. Harvey mentioned one of our fastest growing areas. The LP angle here is, are they really exits? One of the issues against Europe was that a big percentage, as much as 40–50%, were actually secondary transactions, not IPOs as much as. Can I get a quick reaction on that? Maybe you might be wanting, Joe, to grow your secondaries business. So, Harvey, can I give a quick reaction of how you think of secondaries? It's a continuation vehicle, a true exit, yes or no?
Sure. So I think one of the things I find quite fascinating is narratives can be quite stale. I think one of the stale narratives is that there's not an opportunity in private equity because exits were slow for a couple of years, and I think my panelist partners here have covered it quite well in terms of the dynamic in the industry and what's happening. What I also find quite fascinating is that secondaries has been growing quite quickly over the last couple of years as a liquidity solution. But the industry should be evolving with liquidity solutions. I actually think this is a trend that's in the very early days, and I actually think it's quite good for the industry because I think the availability of more exits, more efficient capital allocation is only a positive. And so it's one of the fastest growing parts of our business. I think that's a sustainable trend because I think the industry sector will continue to grow. We may see consolidation. I don't know. And that was the first time I knew there were more private equity firms than McDonald's. I thought it was quite fascinating myself. But I think there'll be a tail of consolidation. There will always be specialist funds, just like there's 4,000 banks or whatever the number is in the United States, but we think of them as the people that were on the stage earlier. And so I just think that this is an early phase of evolution of the asset class where however you monetize, as long as you're monetizing with the types of returns we're talking about, then I think it's actually more proof of concept versus test of concept.
Yeah, no, that's great. Joe, then connecting, you said earlier 50% of your exit activity was in Asia. Can we go back to Asia? You've obviously built the business here, so you're front and center and it's close and dear to your heart. But how do you think of investing in Asia? How is that statistic? Can you unpack that a bit for the audience?
Sure. Love being back in Hong Kong. I spent 10 years living out here from 05 to 15, building out our business initially. So we've been investing in this part of the world for a little over 20 years now. And I would say at KKR, Asia is by far, at least in private equity, our fastest growing business. And the one where we see the most, I think, unique opportunities in this environment today. And I think that's underpinned by a number of just fundamental trends and tailwinds in Asia. There's been a lot of talk about Korea, Japan, and the real opportunities on the back of corporate governance reform. It's no surprise that the Tokyo stock market and the Korean stock market have gone up dramatically since these reforms were implemented. It's just hard to get deals done, right? But you have large conglomerate structures. You have now CEOs and boards focused on ROE. So they're selling non-core businesses, they're selling non-core assets. And we're starting to finally see a pipeline of large-scale divestitures out of companies. For us at KKR and Global PE, outside of the United States, the largest destination of private equity capital today after the US is Japan. And India is probably top 4 markets as well. So Asia is a huge part of what we do. We have 9 offices in the region, around 650 people on the ground, very localized, and around $80 billion of investments in the ground today. So it's that, it's corporate governance and buyouts, corporate carve-outs. It's clearly the tailwinds around domestic consumption in these key markets. 3 billion consumers, Asia 60 to 65% of global GDP growth. As that middle class keeps growing, basic things in consumption, value-added services, healthcare, they're all going to be really exciting areas to invest over time. On technology trends, there's been a lot of talk about AI. I think that's really more of a China opportunity in many ways because, Korea, Japan have great technology, but they're short on energy, and you need both. And they're short on land, right? So China, I think, is going to be the real dominant challenger to the US in AI because they have that combination of assets to really scale AI quite dramatically. But in Korea and Japan, I think there is as big an opportunity, though, given their demographics, the aging population. They are really big leaders in robotics and industrial automation. And I think that that's going to be probably the next 5 years, the bigger opportunity for Korea, Japan, than just pure AI applications. And then I'd say the final thing is really around intra-Asia economic integration. Like, that's a big deal, right? Asia is trading more with Asia. China, Japan, Korea, India, Southeast Asia. Intra-Asia trade is just a little over 60% of trade within Asia. That number's probably going to 75%. So when you think about where to invest in this part of the world, betting on the region, I think, is a pretty safe bet long term.
Great. We're down to the last 5 minutes, so I'll ask the members of the panel for quicker answers on the following rounds. But Rob, Harvey mentioned, and you mentioned, Joe mentioned, more GPs than McDonald's. A fellow European pair, Franzen from EQT, said 5,000 fund managers at GPs would disappear in the last few years. Really? What's your take on that? What form could consolidation take? You acquire one firm in secondary space. What's your take from a European perspective of consolidation, and what will be CVC's approach to it even?
Sure. Well, let me just go back 40 years to my first day in the office, Juan, at 3i, when I started my career in private equity. Hadn't been invented, so it was venture capital back in those days. And I arrive in the office, and the first thing I'm greeted with is, welcome to 3i, welcome to venture capital. You've just got your timing completely wrong, and the industry's dead. And the reason I recount that tale is because, of course, it was wrong, but also over the years we've heard a lot of times, I'm sure we've all heard, that the industry is finished in its current form. And the reason I make that point is because we should never underestimate how adaptable private equity and the alternates market is generally. And that's what's happening at the moment. We are adapting to a very different world. And it's the ability to adapt so rapidly that is such a powerful part of the industry. And so, yes, to your consolidation point, there will be consolidation. And I think consolidation, as Harvey mentioned earlier on, there are going to be winners and losers within this world that we're going through at the moment, the amount of change that's going on. And the bifurcation that we're seeing, it'll all be down to performance. It's always been down to performance. And those firms, I mean, we're all fortunate to be in the situation where performance is very strong. But there are a lot of players out there where performance is less strong. And the LP community is a very discerning and very sophisticated community. And their capital will follow that success. And the stronger will, where they can really bring onto their platforms important and additional aspects, that consolidation will occur. So we acquired our secondaries business, we acquired our infrastructure business, and should the opportunities arise further, no doubt that we will acquire more. But it's also very, very important to say within that it's about culture, it's about scalability, it's about finding real quality so that we can build the businesses going forward. But I'm sure that's going to be part of it. But equally, as Harvey said, there'll be new businesses generating themselves within our environment. And so the environment is just very dynamic. And so I don't see consolidation as being in any way a negative aspect. I think it's a sign of strength.
Connecting, if I may, consolidation with the convergence, also linking it to the previous panel. Harry, you started us off, closed us off on public and private hybrids. We can ask Joe, how's it going? Because you have one, but are you two looking at...
But just to emphasize what Rob said before, I was on a trading floor in 1998 when long-term capital went out of business, and a very senior person was standing behind me. I was just a kid and said, that's it, the hedge fund industry is over. The hedge fund industry sequentially has grown for almost 30 years since then. So I think to Rob's point, calling the inflection point in any industry, banking, public markets, ETFs, public bonds, these are all very, very valuable tools for capital allocation. In terms of the earlier panel discussion, and I want to leave some time for Joe, I think this is, again, not revolutionary. All of us have worked as fiduciaries for municipal workers, firemen, people in the United States for pension plans, and wealth has been a big part of this industry for a long time. It was one conventional vehicle or a wrapper. So again, I don't think this is revolutionary what's happening. This is just about asset allocation. And I could agree with both Manny in the last panel and with John about the debate around where you're going to get a better return. I think ultimately it's how people think about their own portfolio construction. But this is, again, completely evolutionary. I don't even think of this as particularly creative corporate finance. I think this is just about solving a client problem globally, whether it's wealth, mass affluent, or in the retirement channel where we've been providing these services for a long time.
Rob, may I rudely skip you and give Joe the last 20 seconds? How's it going?
It's going great. I mean, we have an amazing partner in capital, and you heard from Mike Gitlin earlier this morning, so it's the early stages of this partnership, and I think as people have said this morning, this is really about giving individual investors more choice, fundamentally, right? So if you're a doctor or a dentist in the United States, historically, you don't have a big pension plan, so you don't have access to the alts. Really what these products are fundamentally doing is democratizing access to the alternative space and giving individuals just that much more choice. So it's going to take time. This is not going to be a silver bullet, but I think in the next 10, 20, 30 years, you're going to see that wealth channel be a major part of the alts industry.
That's great. And that's a wrap. Thank you so much to the panelists and the leaders. Thank you.
Thank you very much, our speakers. Please remain on stage for a group photo. Please now look towards the back for our media friends. Thank you very much. You may now be seated. Diversification. This word has been a buzzword in recent months, but where should we diversify into? From Europe to Asia and beyond, and across different asset classes. The next panel will provide insights into where growth and investment opportunities can be found. The session will be partially conducted in Putonghua. You may use the headset in front of you for English simultaneous interpretation. Let us now put our hands together to welcome our moderator, Bonnie Chan from Hong Kong Stock Exchange, and our panelists, Valerie Botson from Amundi, Ronald O'Henley from State Street, and Zhang Hui from Bank of China. Bonnie, over to you. Thank you.
Thank you, and good morning to everyone. I'm sure everyone has been enjoying the summit so far, and this panel is about diversification from Europe to Asia and beyond. And diversification is a word that we've heard a lot of this morning. In fact, I think it's prominently featured in quite a number of preceding panels. And of course, we have seen a significant reallocation of global capital this year as investors respond to many things, right? From the geopolitical side of things to macro volatility, and also as we see increasing growth and risk management opportunities. So as the world seek for this new equilibrium, shall we say, I think we should just expect this trend of diversification to continue. So I think for this panel, we really want to look into what it means for the different geographical areas. And I have to say, Hong Kong has benefited from it. I mean, you've all heard about how the Hong Kong market has fared this year. It's very refreshing to be referred to as the tip of the spear as opposed to the relic of an international financial center. That unfortunately was a label put on Hong Kong a few years ago. So we're very fortunate today with this panel. And so without further ado, let's get started. And I would like to start with Valerie. So Valerie, we are seeing opportunities arising from the EU's competitiveness agenda. And I think similar to the Hong Kong market, quite a number of European markets have also done very well. The DAX have improved more than 20% year to date. So can you help us understand this? Whether you are seeing, in fact, global investors pivoting more towards European assets, and what does it mean for a firm like yours, Amundi?
Well, thank you very much, Bonnie. Good morning to everyone. Yeah, let me start maybe by drawing very quickly the European political and economic agenda to answer your question. There have been a few initiatives, 3 of them mainly, over the past few months, which I think are very interesting for Europe and we should attract worldwide investors. The first one is the launch of the Savings and Investment Union. The idea here was to make sure that the abundant savings of European citizens can be channeled very directly and very clearly towards long-term investment in order to speed up the competitiveness of Europe and European industry and economy. The second one, of course, is around defense. You may have heard about it. EU increased its financial commitment by multiplying by 5 the budget in the European Competitiveness Fund, the defense budget. And as you probably know, we also have European countries which we committed to invest 5% of their budget in defense by 35. So this will obviously increase the valuation and the dynamic of defense companies in Europe. And last but not least, Germany, which was known for its very strict fiscal orthodoxy, has launched an ambition, a multi-year plan to invest in infrastructures. So I think all these 3 initiatives are going to be very good for the economy in the short term and will be, I would say, speeding up the valuations of some company. And if I may add, 2 more structural reforms which are being handled on the financial area. The first one is around pensions in Europe, which is transforming everywhere. You know that the population is aging worldwide. It's specifically true in Europe, and the pension system is being reformed country by country, sometimes in a different way, but all the time with a clear vision of feeding long-term investments toward Europe. And retail participation to markets as well is being very much encouraged. For all that reasons, I think we should be comfortable and positive about the future of European economy. And we have been seen already and will go on seeing investors from all over the world participating to this growth.
Thank you. So 3 initiatives and 2 structural reforms. In fact, I always tend to think about Europe in a similar fashion as Asia, because I think both regions, we see quite a lot of fragmentation over the last few years, and therefore, if there's a chance to really have all the different countries and markets within that region joining hands, that should create a much stronger momentum. So with that remark, maybe I'll turn to Mr. Zhang Hui, and I'm going to ask this question in Mandarin. So if you need translation, please do use the headphones.
Mr. Zhang, this morning, we have listened to the leadership's instruction about consumption. Can we know your view on China's ambition to build a mega-sized consumer economy to boost private consumption? How would that affect your various business sentiments regarding your bank's business, such as retail or institutional business? What kind of impact do you think it would bring? Thank you. You mentioned that China wants to be a mega-sized consumer economy. This is not only a vision, this is also what's happening right now. From statistics, we have already seen that. The first 3 quarters this year have seen a great contribution to GDP from consumption, around 53%. Up by 2.8 percentage points. And our research institute also predict that during the 15th five-year plan, that this number would increase to 60%. So it would provide a lot of driving momentum to the economic development in China. China has a great population. It consists of great potential in consumption. In the past, maybe the consumption more or less like in the product consumption. But the next focus would be service consumption and also consumption in some new emerging areas. As you know, that China is also going through a aging transition. Have a higher growth of GDP per capita than the overall GDP growth. And the second part of the question is about the impact on our business. In the first 3 quarters, the individual consumption loans increased by 26%, and in the service area, 17%. And this has already exceeded the growth rate of our asset, which is around 7%. So it has provided a very good foundation for our business growth. We will protect this opportunity, and as you know, that BOC is an internationalized bank, and we also want to utilize our role in 37 countries and regions. We already provide individual business and services to the greater Chinese community in 37 countries. And as we know that there are lots of convenience for foreigners visiting China. So now we have the tax refund business in the 19 provinces and autonomy districts. And these can provide great support for tourism and domestic markets. And we can also provide different kind of consumption loans and financing to guide or tap into the potential of consumption. On the supply side, we would focus on service-related consumption and new retail consumption, and we will provide financing support. So we can cover both the supply side and the demand side. On the other hand, we can provide asset management service to the individual consumers to enhance their capabilities to spend. So we will grasp that opportunity on that front. Thank you, Mr. Zhang.
This topic of consumption is an interesting one because, we were earlier talking about diversification, and, from my vantage point, when I look at my pipeline of companies waiting to get listed on the Hong Kong Stock Exchange, I would say half of them are in the new technology space. So a lot of biotechnology companies, specialist technology companies, AI, energy transitioning. But also quite prominently featured is new consumption, what we call new consumption, and the idea of intellectual property. Companies focused on really developing an equity story out of that concept is a growing part of the pipeline. So, I guess we should monitor that space. So let me now go to you, Ron, and let's maybe go back to the more traditional asset classes or things which investors generally consider as safe havens, US Treasuries. Do you think that's really challenged as the ultimate and primary safe haven asset? And what do you consider as alternatives? Over to you.
Well, firstly, let me just thank the HKMA for yet another great convening. And your question, Bonnie, really is, I think, about U.S. Treasuries embedded in it. Is the U.S. still a great place to invest in or not? And certainly that bet has been a great bet for a very long time. If you think about performance, both equity and the Treasury markets, it's been a great place to be. And it's actually really hard to question that even now when you think about the performance of U.S. companies, the profit levels of U.S. companies. But it is a different moment right now. We've got this, you can call it what you like, you can call it a reordering, you can call it a deglobalization, you can call it a reglobalization, but both in trade and capital flows. Secondly, you've got a fiscal situation in many parts of the world, really driven by sovereign debt. The U.S. isn't the only one, but it's certainly in terms of the sheer volumes. We have a debt situation there. And we've seen, certainly we've seen the rates on treasuries go up. And the question then becomes, is this and when you see what's happening with the dollar, is this a de-dollarization or is this a depreciation in the dollar? And I don't think we know the answer yet. My own view is that it's going to take a long time to de-dollarize. I'm not sure it'll happen, certainly in the careers of many here. But I think that the role of the U.S. and treasuries and the dollar has been, is being challenged now. But the point that I think you have to make is, how do you think about it going forward? It's been a great bet in the past. How do you think about it going forward? And while the U.S. administration isn't always the clearest communicator, I think what's the policy embedded by all the tactics that you're seeing is one of growth, and a belief that if sustained growth can be kept at or above the 3% level, that the debt situation actually takes care of itself. There's been an agenda here. The first, and we can disagree with it, but here's the agenda. The first has been around tariffs and this idea of let's bring manufacturing back to the U.S. The second thing has been about taxes. And the third has been about deregulation. The administration more or less started in that order, but now it's going on all three. And to the extent to which you believe that that can make a difference, I think the challenge for the U.S. Is that overlaying all this is an immigration policy that I think actually can be anti-growth. And if you look at the U.S. over really almost its entire lifetime, it's been fueled by immigration. In modern times, U.S. demography would look a lot like European demography, but for the fact of immigration. And we don't have that same level of immigration any longer. And it's not just illegal immigration that's being stopped, but legal immigration, including the kind of immigration that's really driven a lot of growth, a lot of prosperity, a lot of company formation in the U.S. So to me, the biggest challenge to all that we're seeing in the U.S. will be what happens in immigration, and do we have, what kind of policy emerges from that? Right now, there's not a clear and coherent policy. So having said all that, to finally get to the answer to your question, I do think that treasuries are, it's going to take a little bit more to spur buyers of treasuries. The U.S. is unlike Japan, where lots of government debt is basically bought internally. Most of the U.S. government debt is bought externally, and people and investors will be seeking a yield.
Thank you. So the jury is still out whether we are seeing de-dollarization or a depreciation of the US dollars. Now, this clock is ticking rather fast. So I would like to ask a perhaps impossible question of all three of our panelists, which is, reflecting on everything that we've heard today, and the theme of this summit, tracking the shifting terrain. So just imagine you have the magic wand and you can put together a perfect investment portfolio, and let's put a time frame to it, right, for the next 12 months. What geographies, asset classes, combination are you going to put your money on? We'll start with Valerie and then on to Ron and then finally Mr. Zhang.
Well, I think that, as you know, we have at Amundi, we are a leading European asset manager. But we are based worldwide, and most of our clients are either European or Asian. So I will answer with this important DNA that I share with our European and Asian clients. What I see is that they're all questioning their US heavy exposure today. First, they've been reassessing their aging strategies recently, considering the dollar topic we just mentioned. And when it becomes too expensive, they're really looking for diversification, which is what we really, really advise them to do. Speaking about Asia, I think that globally Asian assets are very well positioned. The valuations are globally attractive when we compare them to in a worldwide area. Of course, you need to be selective, but Asian assets for us are a must. In Europe, I think investment-grade corporate bonds are interesting, and when we speak about equity, we always look today mostly at quality business and valuation. If I had one advice to keep is to switch from a market cap weighted portfolio to a GDP weighted portfolio. I think it's the best way today to be clever in diversifying your portfolio.
Well, I like that answer because that's a little biased towards Asia. Ron, over to you.
Yeah, I'm not going to focus on geography. There's been a lot of talk here and at every conference we all go to about AI. Is there a bubble? And it really is. If you think about where all the investment is, it's in effect been about the infrastructure and the hardware. I would be highly focused on trying to figure out who are the companies that are actually going to apply it well. The application really is in its early moments here. And for good reason, because to actually do it right, one, you've got to get your data right, and that's a combination of getting your data in order and then putting the right risk and controls around it. Secondly, then, you've got to get your processes right and re-engineer those. I mean, there's no point in automating the crooked line, as they say. And then thirdly, actually then apply it. And to the extent to which you can figure out who those companies are, and there's no reason why they should be geography bound. So I think you'll see new champions emerge as a result of this. We were talking about beforehand in the session, I actually think that for all the money that's being invested in the hardware and the enablers and the infrastructure, I don't think it's going to be the same level of investment to actually apply it. And so that's what I'd be thinking about. Who will be the new champions that are going to disrupt existing industries? Some of it will be new disruptors. Some of it will be incumbents, though. They're going to figure this out quicker than their competitors.
Yeah, that's certainly what every one of us has to think about all the time recently. So finally, over to Mr. Zhang, 一个完美的投资组合。
Perfect portfolio. What are you going to allocate? I think from the banking perspective, we are more concerned about the allocation of our business in different geographies. We have all along been international. When our internal environment has been changing and globalization has also impacted on our international efforts. So I can give you some figures. You would know that right now we have a low interest rate environment and commercial banks are facing a lot of pressure. But because of our international foothold, through our overseas business in relation to the support to our revenue and also profit, there is good hedging. In terms of geographies, we will focus on Hong Kong, of course, which is our camp, base camp. We have been deeply rooted in Hong Kong with great level of influence for many years. We will further expand our investment into our business in Hong Kong. It's my first time to come to this summit, and that has consolidated our confidence further. We are together with many financial leaders here talking about the future. This shows how vibrant Hong Kong is. BOC Hong Kong is a platform that faces the rest of the world. And a number of years ago, well, I think 8 years ago, we have started the construction of our regional headquarters. By leveraging on the Hong Kong platform, we have been radiating our business to the rest of Southeast Asia. And this region provides very good support to the BOC's operations, and the regulators have widely recognized our efforts. So for the next step, we will deepen our roots using Hong Kong as a platform to expand into more places in Southeast Asia, and then also in Central Asia, Middle East, and also Europe. These will be our important targets looking ahead. Today, we also talked about AI investment. I think we are more concerned about investment through the LLM, but we need to shift our attention to AI plus, how it supports our industries. In what areas, through effective use of AI technologies, we can create explosive growth in our industries. I think that is the right focus. Thank you.
So unfortunately, time is running out, but I'm sure that all of our guests have really enjoyed this conversation. So once again, let me thank Valerie, Ron, and Zhang Hangzhang for your time and insights. Thank you very much.
Thank you, Bonnie, and our speakers. Please remain on stage for a group photo. Please now look towards the back for our media friends. Thank you very much, our speakers. You may now be seated. Thank you. Digitalization and urbanizations have profound impact on our cities and infrastructure, particularly for the demand, generation, and transmission of energy. This panel will discuss the outlook of this sector and how investments in it could shape a more sustainable future. Let us give a warm welcome to our moderator, Neo Shen from HSG, and joining him on stage, we are delighted to have Jim Coulter from TPG, Bruce Flatt from Brookfield, and Shamara Vikramanayake from Macquarie. Neo, thank you. Over to you.
Well, thank you. I'm glad, very, very glad to be here, and this is my 4th year attending the event. Congratulations to Eddie and the HKMN team to putting together another amazing event. I think today's topic for this session is about new energy, but broader base infrastructure. So we have a great panelist here. I don't think we need any introduction. Jim, Bruce, and Samara, I think has been actually recently hit some headline news with their respective investment in this segment. So let's start from AI, because many of those demand for energy and for new energy are actually driving because of the AI. I think tremendous of increase of capacity. So I'll start by asking Bruce. I noticed that you actually were speaking about AI data center just about last week. Yes, you were saying that we can't build enough data centers. So what's enough for you? Your research paper published recently was calling for a 75 gigawatt of AI data centers for the global. And that means 7 trillion investment. That's a lot. So, sort of what's enough for you, and do we have enough demand for that? Because we will heard a lot of comments in the early panel about, oh, there is this bubbleness in the AI investment journal, in journals. What's take on that?
Thanks, Neil. Thanks, Eddie, Howard, Sampson, for having me. I'd start off by just saying I think the perspective has to get changed a little. Before we built railroads, highways, all the infrastructure, water systems of the world. And what countries and companies are now doing is laying the backbone of the advanced digital economy that's coming. And when you put that into perspective, what needs to get laid down is that layer of infrastructure across the world to be able to drive business over the next 5, 10, 15, 20 years. And I think that's really what you need to put in the back of your mind. We're just laying the backbone of infrastructure, and all we've ever done in our business is just build backbone infrastructure around the world, and this is just the next layer of infrastructure. And what's really important to recognize is that it's very difficult to do what's going on. And the easy sites for data centers have been used up. Like literally every site 3 years ago that we had entitled was 100% contracted. And now it's hard work to find the next ones. And the good news, though, and this is where there isn't a bubble, because every single one of those is contracted for 25 years with the best counterparties in the world, and those today are either sovereign credit, so we're leasing it to countries, or they're hyperscalers with trillion-dollar-plus market capitalizations. And that's what's different. When fiber was laid down and everyone said we had Global Crossing going to go bankrupt, and it did, there was nobody leasing the fiber. What's different today is these are all, virtually all let on 25-year contracts. So I think we've got a long, long runway to go in this, and the inhibitor is power and execution capabilities. So it's not capital.
So you're basically alluding to that hyperscaler has such strong financial power, and they have cash flow able to support it. And that's something you are better.
Yeah, these are 100% let often to very well endowed organizations which are driving enormous profitability within their businesses today, not from artificial intelligence, that hasn't come yet, but they're investing today.
Legacy cash flow.
They're spending $500 billion a year, let's say for the next 5 or 7 years. That's $2.5 trillion. In the context of their businesses, it's not that much. And what that is laying the foundation to be able to deliver enormous profits a decade, 15 years from now. And if this all works out, these are going to be $10 trillion companies.
Looks like a good math. All right, Samara, so while Bruce was talking about not enough, you are also selling those data centers. You had actually some wonderful exit, right? I mean, last year you sold AirTrunk for $24 billion. This year you just sold another major data center for $40 billion. I'm pretty sure you have your LPs or your investors must be very happy about that. Are you also put the money back to that space? I mean, and tell us how you look at that space back many years ago when you building those data centers.
Yeah, and look, Ben Way, our head of asset management, is here with me, and we've had a few people asking us whether we've been calling a bell at the top in terms of data centers by exiting a portfolio here in Asia for $24 billion, as you said, last year, and then one in the US for $40 billion. But what I would say, I mean, there's been some really interesting perspectives given by people here both ways in terms of the growing demand, but then also the challenges with increasing technology with compute capacity and things, and will the demand be there, and the small group of off-takers there are. But I would say basically these exits reflect more the fact of the role we play in asset management, which is we start at the early stage and take things from about the zeros to the 20s, and then there is other capital that is well positioned for the 20 to 80 phase and other for the more stable 80 to 100. And so, you know, when we invested in AirTrunk, we took it from 450 megawatts to about a 1.8 gigawatt portfolio, 11 sites. We took it from Australia and Hong Kong into Japan, into Singapore, into Malaysia, and then we exited at a point where the capital required to keep that journey going was beyond the scope of our funds. And the same with Aligned, which we exited in the US. I think when we invested that one, I think we had AirTrunk for about 3 or 4 years. Aligned we were in for 7 years. And we saw opportunity there to start very early with 7 megawatts. We grew it to 1.6 gigawatts of contracted offtake when we exited it. So we're selling a portfolio that it went from 7 million of EBITDA to 1.6 billion of EBITDA. So the people who came in are holding a more mature asset, but still scope for growth. So I think it's the role we play, and in private markets, there are many of us that play different roles. There are much larger funds that hold it through the next phase. The other thing I would say is here, have 5 data center portfolios left. So even though, yes, we did start 7 years ago in this area, we've got a couple still in the US, smaller ones we're developing. We've got one in UK, Europe. But here in Asia, Joe Bay was saying earlier that China is a big opportunity. We have a portfolio in China. We have one in Korea for North Asia. So we still see scope to invest in the area. And the last thing I'd say is this digital infrastructure for what's coming is not just data centers. There's all the fiber optic networks needed for it. There's towers, there's subsea cables, this transition that's happening. And particularly, I think, you know, those of us here are focused on the Asia region for these sessions. And we have 50 portfolio companies in the Asia region. We think there's a lot of scope here, particularly with lower risk to keep investing.
Great. And Jim, I know you're also building massive data centers, but I want to ask you a different question. I mean, we all talk about massive capital, but what about human capital? What are the technologies going to make a difference in building those data infrastructures?
So I'm an investor, and it's always critical to get the questions right. And that question is interesting to me because no one's been asking it. So let's think about the questions we've been asking. Is it going to be big? I think we'd all raise hands. This is going to be big. Is there enough money around to do it? I was riding up the HKMA elevator, and the little TV screen said, you know, investors clamoring to get an AI. I'm not worried about money. You're right, Bruce. They've got $40 billion or $20 billion market cap. They can borrow $2 billion to do data centers if they need to do it. And is there going to be a bubble? We've asked that 5 times. Of course there's going to be a bubble. There is in every major. The idea that the market would totally land this perfectly is of course wrong. But here are the questions that are much on my mind. The sheer physicality of this, as you're talking about. So the biggest thing in real estate right now is Jamie Dimon's new headquarters. $3 billion in New York, it's taken 10 years, articles everywhere. I'm sure you guys are doing the same thing. We have one project in Texas that is $40 billion that we're spending in the next 3 years. No one's written a single article about it. How is that going to happen? Or if you go to the high level, the 10 biggest energy companies in the world outside of Aramco are $2 trillion. Data center spending over the next 3 years is going to be $2 trillion. If data is the new oil, we've got to remake the entire energy business in the next 3, like, how is that going to happen? And the question, I don't have a good answer, but if you ask that question, if you figure out how that's going to happen, there is massive opportunity. The second question behind that, though, that no one's asking is, like, who's going to do this? All of you are looking for AI advisors. I moved in high school. The first people who want to be your friends are not the people you want to be friends with. If they are advising you and they're really good, they should be in San Francisco, because I can tell you that's where it's happening. There's $200 million pay package if you really understand. Likewise, you guys know there isn't the human capital to build a lot of these data centers. The old data centers are real estate plays. They were just hook it into the energy, hook it into the trunk. Like, these are total, we're building massive energy malls. There's only a few people around the world that these large hyperscalers are going to trust to do it. And then, are you even thinking about it right? We tend to think by asset class. To understand what's going on, you've got to have technology, you got to have chips, you got to have services, you got to have a supply chain. So this is a massively complicated set of questions. And we keep asking the same question over and over again, where the benefit is going to be in these questions that were maybe not even asked. So if you go away from this, I hope you'll actually take some questions home with you, because I certainly don't know the answer, but one of the great techniques in investing is to buy complexity and sell simplicity. So if we can buy the complexity of this market and figure out the simple answers, you know, that's the key.
Great, and we all knew that, you know, energy is a key bottleneck of that AI ramp up, right? So Jim, I mean, when TPG Rise gets set up, you talk about, you know, green transitions, new energy investment, but clearly with the tremendous growth of AI demand, you're not just looking at new energy anymore, right? So, you know, we heard some new buzzword, nuclear, which was not the case back 2 years ago when we talk about solar and wind. So what are the pockets of opportunity in the new energy space that you are most excited about, or broader base energy?
All three of us will have a lot to say about this, but there's been, you need to first of all start with a totally different mindset than we all had a few years ago. So let me just go through the mindset shift that is happening. First of all, we were talking about energy transition. The key now is electricity addition. Energy and electricity are not exactly the same thing. As you guys know, in an energy transition, heat is important. Electricity has different attributes and has different winners in that. Second thing is, we were all focused on policy up through August, like what would they do with grandfathering. This is no longer about policy. This is totally about practicality. And it is no longer a religious debate over whether it's fossil fuels or not fossil fuels. It's essentially all of the above. So, you know, you guys have a great deal going in nuclear. So it's nuclear, it's everything, because we are short electricity in the world for the first time. In the US, we haven't been short in a long, long time. And so the entire mindset has changed. And we now are going to see, you know, just back to my sizing of this, the 3 biggest electricity companies in the world have a combined market cap of 200 million. And we're going to spend $200 million on the electricity market each year for the next 5 years in the U.S. Like, I have no idea how this is going to happen, but it's going to be interesting.
Great. So Bruce, back 2017, you bought a company called Westinghouse, which just came out of bankruptcy. Today, it's a company was just announced last week, is entering into an $80 billion contract with U.S. government, right? You're going to build a massive nuclear reactors around the world. Tell us about that investment, how that fits into your overall energy portfolios.
So we have been for 30 years one of the biggest builders of power plants. We started in hydro, we went to wind, we went to solar, and in 2017 we saw an opportunity to buy a nuclear company at a value which was how much you paid? Which was a value-based purchase. We put $1 billion of equity up, and we thought if nothing changed in the world, we'd do okay, and if odds favored that clean energy with nuclear was eventually going to come back, we just needed time. And I don't think we could have expected what happened over the last 5 years. As you know, and maybe just to step back on Jim's comment, is almost every single country of the world, but in particular in the United States, which is the largest consumer of energy, the grids are going to need to double over the next 15 to 20 years. The grids are going to double over the next 15 to 20 years. They've been flat for 25 years. That's what's going on. So the US government just gave us an order to buy upwards of $100 billion, but $80 billion to start off. It might be double that of nuclear plants. And the reason they did that is because they recognize that we need to restart the supply chain for nuclear in the United States to be able to build. And we were going to build one plant on our own, finish one in the United States, but we needed 10 to be able to build the whole supply chain out in the United States. So they committed to buy these nuclear reactors in the United States. They're going to give us locations for them on federal lands, and it's going to be really exciting for the sector. But maybe to the point, there's over 1 million gigawatts of power in the United States, and this is 20.
Nuclear.
Yeah, of total energy consumed for electricity, this is 20. What the point being, we need all of the amounts of energy of what's going on because of electrification of industry, of cars, and of data centers consuming enormous amounts, and so it's a very significant thing that's going on in the U.S.
Just to size this, and I'll jump off a second. Why do you get excited as an investor? The market for energy addition has been about 29 terawatt hours a year in the U.S. for the last 15 years. It needs to be 400 terawatt hours for the next 5 years. So we have a market that needs to increase 10 times, and we have high payers coming into it who are willing to pay 2 to 3 times market to get power faster. Again, I have no idea how this works out, but this is a really interesting set of questions.
Great. So Samara, you also put a lot of money into work in the new energy space, right? You just raised a new fund, actually, for that. Tell us, your sort of investment strategy in this new energy in connection with the AI, increased demand.
Yeah, and I think as Bruce said, it's not just AI, and Jim said it as well, everything is electrifying now. So together with population growth, urbanization, all of that, these new trends of electrification of transport, everything is driving very big demand. And I think, sadly, we're dealing now, I know previously we had a sustainability climate focus on this, but we realize now we have to thread the needle between availability, accessibility, and also the affordability of energy sources together with dealing with the climate impacts of it. And that is a difficult needle to thread, but it's going to need massive investment, not just in generation, which is what we've been talking about, but we need a lot of investment in midstream infrastructure as well. Grid capacity is constrained in just about every market. We're in transmission, distribution, also pipeline networks. So I think it is a big area that's going to need investment. the regulatory frameworks play a role in a bunch of this investment, especially bringing on new technology where they have to catalyse private sector investment through some support, but then also the planning approvals, etc. So having a good glide path for each country is important. So I think we work also with the public sector in most of the regions we're operating in to try and think about that glide path and what role our private capital can play, but we're going to need a huge amount of capital, expertise, etc., to deliver this.
Thank you. So let's go back to the legacy infrastructure investment. Bruce, so you also invest heavily into commercial real estate globally. What is the dynamics there? Do we see that market coming back as people back to work? What's your take?
So real estate in general, it's a cyclical business. One should always remember that. And there were two things that happened this time versus others. Interest rates went up quickly, and their mindset changed that people were not going to go and be in places. I think those are the two fundamental things. Each cycle is different, and this time it was those two. On the opposite side, fundamentals of most real estate in the world, Hong Kong a little different because the leases are short, but in most other places of the world, fundamentals are really strong. So you have underlying fundamentals are strong. What happened was the psyche of lenders and buyers got messed up, and interest rates went up quickly, and that affected financing. What's happened now is that interest rates are coming down. Everyone understands, everyone's going back to the office, and all other forms of real estate are in excellent shape. What you've seen now is in most cities in the world, there is no construction going on, and there is no space left, and rents are going up rents have doubled in New York in good buildings, and they're going higher probably by another 50%.
What about Hong Kong? You're here, so what's your outlook for Hong Kong?
Yeah, so Hong Kong, here's what I'd say. There are greater experts in this room on Hong Kong real estate, but I'll make one broad observation. This is in all value investing in real assets, but in particular in real estate. If you have businesses or cities that are great places, Hong Kong qualifies. And if you have a tough market where things are down, they come back fast. And Hong Kong's turned, and there's very little construction. It's a very constrained place, and real estate values here will come back and be at their peaks at some time in the future.
Great. I hope that future is very close. All right. So
I wasn't talking about your apartment.
Okay. So one last question for Samara and for Jim, right? So we talk about data center, energy. It seems to be that we're assuming there's unlimited capitals available out there, right? But in reality, who's going to fund those big investments? We knew that institutional investor has always played a very important role, including the sovereign wealth funds. But is retail have to be part of that picture, and how we look at that sort of, the supply side of the capital?
Okay, sure, I'll go first. So look, basically there are hundreds of trillions of pools of savings in individuals, in institutions, in governments out there in the world, and I think what we do as asset managers is we connect those savings with investment opportunity where we have expertise to deliver superior risk for the return. What we've been seeing is that pools of saving moving much more from markets like equities and fixed income into private market type assets, the less liquid assets. And that is happening initially through the institutional channel, but now through the retail channel. There are growing mechanisms, intermediated wealth, or now we talked about the 401ks in the US to allow retail to access this. Also insurance is looking to allocate more to these higher return potentially, but more illiquid and maybe more complex risk assets. So I think what we do is act as intermediaries where we each have our expertise to bring those pools of capital to investments through unlisted markets, listed markets. I mean, Bruce, you have a structure with listed entities at the top using listed markets. A lot of people use unlisted. We're moving more into insurance and wealth. And I think basically, the allocation overall is shifting where people are getting more comfortable taking the risks. Now, we do have to think about the illiquidity risk, particularly as we do this with unsophisticated investors, and make sure they're looked after as they go into this. But I think we are seeing more allocation to private markets. And I'll let Jim have the last word.
Jim?
Watch the private markets here. If you remember the 2000 tech bubble, we were actually right that the internet was big, but too much money was trying to go into it. 20 pounds of money was trying to go in a 5-pound sack. Same thing might be happening in the public markets now. But while that public market bubble happened in 2000, over in the private markets, we were creating Amazon, Google, later Facebook. So the business models are what to focus on here. Who has the best business model? If there's a good business model, capital is not the thing I worry about.
Great. So we're running out of time, and let's put our hands together and give this 3 panelists a round of applause. Thank you.
Thank you very much, speakers. Please remain on stage for a quick photo. Please look straight to our official camera. And now it's towards the back for our media friends. Thank you very much, speakers. You may now return to your seats. Technology is set to transform the financial sector. Our next panel will explore how the latest innovations will disrupt and revolutionize the way financial services are delivered and what the future holds for industry as a whole. Let us give a warm welcome to our moderator, Ernesto Torres Cantu from Citi, and our panelists, Jenny Johnson from Franklin Templeton, Danielle Pinto from JP Morgan Chase, and Bill Winters from the Standard Chartered Bank.
Very good. Good afternoon, everybody, and thank you, HKMA and Eddie, for another wonderful event. Being in Hong Kong for 123 years, actually, city, we've been, witnesses to its transformation, its innovativeness, and adaptation, which is certainly happening again. And talking about technology, and given that during all morning we have not spoken about AI, we wanted to take it to Ron's comment, to the applicability, more than the evaluation, et cetera, in that sense. And let me start with Jenny. Jenny, how is AI transforming, business operations at your firm, and what strategic considerations should companies keep in mind to stay competitive in this field?
Well, I think if you're not thinking about how AI is transforming every part of your business, you're not thinking broadly enough. And I almost think you have to think, what is AI not going to do in my business that we can add value by doing? And so, the challenge always with technology is the first thing that anybody looks at is you make more efficient what you do today. You get the tool in the hands of your employees, and then they start to give you ideas about how you can really make the next level of change. So right now, we're at that stage of figuring out, okay, how can we be more efficient? RFPs used to take us 18 hours to do the first draft. It's 14 minutes now. From our investment teams, if you think about it, an investment team has 3 decisions: buy, sell, size. And so we've created models within our investment teams where you put in the team's philosophy, you're looking at historical trades and data, and then as you're making decisions, it actually can challenge the investment person. So the research analyst, well, you actually say this, but now you're recommending this because there's always biases. On distribution, it's about how do you optimize the time of your salespeople. So who are they visiting, and are they having the best conversation? And all that, you obviously have the data internally to provide those insights. It takes time to hone the models, but we're looking at, really every part of our business, and obviously technology, creating code, every part of our business to try to push it forward to leverage the technology.
Thank you, Jenny. Daniel, in same concept of applicability, and also how do you see them evolving to just a productivity enhancement tool or more than that?
So I think that as a big company, traditional company, so the way to succeed, in my view, is to look at, as Janie said, every part of a company will be challenged or transformed. But then how do you think about it? In my view is you have to think if that piece would have been AI native activity, how you would do it, and then try to get the organization to move exactly that way. So we started investing in AI like 10 years ago, and the bulk of last year, we do measure the value more or less, and we got around a couple of $1 billion in value, either cost savings or losses being avoided or revenues being produced. And that number is being growing roughly at 30–40% a year. And I think that it will accelerate. But the bulk of what has happened so far is traditional AI. We are now seeing the beginnings of the increase in productivity driven by large language models. And probably the next step will be agents and how those are going to increase not just productivity in operational processes, technology, call centers, but things like in research, enhance the capabilities of our researchers, in bankers, particularly junior bankers, that they can become a lot more productive and go and face clients a lot sooner. That instead of doing presentations that can be done or filing things that can be done by technology. So I think that this is very transformative. I think that increasing productivity will increase the ability to customize client experience, develop products, target marketing, create client experience where the client group will be one client, and to make it really make the best for that particular client is going to be very transformative. And we are essentially at the very beginning. So I see a lot of growth, top line and bottom line going forward.
Bill, and I see you agreeing with Jenny's and Daniel's comments. No? Do you see the impact in the medium term, like it has been suggested in other panels, etc., or short term and immediate?
Past, present, short term, medium, and long term. I think all of the above. I do agree with Daniel and Jenny on everything that they said. I think including the fact that we were engaging in AI before we called it AI. We called it data analytics, and we used it for fraud protection and transaction monitoring and name screening and the sorts of things that large language models were very useful for. But I think like a lot of us in the corporate world, we got excited about the technology, and you go back 2–3 years, we looked around the bank and we had thousands